about to hear my conversation with our chief fixed income strategist, Dustin Reed. We talk all about fiscal and monetary policy in the U.S., what's going on with the U.S. dollar, as well as what's going on within their portfolios. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. My name is Matthew Schnurr, and I'm delighted to be back with Dustin Reed, our chief fixed income strategist. Dustin, welcome back.
Matt, great to be back with you on the program.
We always schedule to have you on around central bank meetings, and the Fed did meet just yesterday. They held interest rates, which was largely expected. What else did you take away from the meeting?
Yeah, absolutely. So the Fed did hold yesterday to the surprise of hardly anybody. I think literally zero was priced in to the market, but there were a number of other interesting things around the outlook and in the press conference that I think are important for investors and important for markets. The June meeting obviously happening yesterday, so it's a forecast round for the Fed. So it's a little more detailed for that meeting than some of the other meetings that are non-forecast meetings. In the forecasts, we saw the Fed evolve its thinking for calendar 25 and 26 and beyond from the last forecast round in March. And everyone obviously focuses on the dots. The dots suggest to me that we are seeing a committee, and when I say the committee in this case, it's everybody that participates, not necessarily just the voters. But the committee of participants, which is 19, is becoming more and more bifurcated, in my opinion. And by that, I would say that, okay, so of the 19 dots for 2025, and after yesterday, there are now 4 meetings left for the rest of the year. So just to keep it in perspective. And so of the 19 participants, 9 of the 19 expect no cuts or one cut, 1 by 25, for the rest of 2025. And then 10 expect 2 or more, but it's, in this case, it's 2 or 3 cuts through the rest of 25. And of those 9 that expect nothing or 1, 7 expect nothing. So you've got a handful at 3, a large majority at 2, which is where it stayed versus the most recent forecast round, but a bunch at 0. And that tells me that there are numerous different opinions, definitely more than 2 camps within the participating folks around the table. Some will be focusing on the growth side. Some will be focusing on the inflation side. Some will be focusing on the tariff side. And there's a fair bit of, I think of probably healthy debate going on around the table at the Fed. And Powell at the press conference yesterday was very emphatic that he believes that the Fed is in a very, very good place for rates, and they're very comfortable with where rates are now, which of course is a range 4.25% to 4.5%, and he thinks that that's a very good spot for where the Fed should be. The Fed is still not completely sure which way things are going to go. They seem, from the formal statement, they seem a little more sure that the big uncertainty is behind us, behind them, but there's still a fair amount of uncertainty ahead. And by that, it probably means fiscal and tariffs. And I think the Fed is waiting to see what the hopefully somewhat of the net results of the tariffs will be come early July, and maybe China early August, and what some of the pass-through will be on prices. It's very clear that I think it's the median on the committee. It could also be Powell's own view, but I think it's the median on the committee, and it could be both, that although the inflation data has been relatively weak the last 2 or 3 months in the US, that the Fed strongly believes and expects that inflation pass-through from higher tariffs will start showing up in the June data, which will print in July, and the July data, which will print in August. The Fed is basically pounding the table that it really, really strongly believes that that's going to happen. And I have some sympathy for that view. That's kind of been our view as well. I would have expected a little bit more this most recent round, the May data that printed in June, and there really was not. But I have been kind of targeting July, the June data in July, and then the next 1 or 2 months after that is kind of when we're going to see the inflation pass through, or not. And keeping in mind, obviously, that the average tariff rate has probably gone from around goods has probably gone from around 2.5% to 15%. So like, that has to show up somewhere. And there's obviously a lot of pieces in the supply chain where that can be absorbed or passed on, et cetera. But it has to show up somewhere. So I think the Fed is in a comfortable spot. I think the June meeting was not totally insignificant. There is a meeting in late July. It's not a forecast round, and I don't think that that's a big deal unless the labor market falls apart
Hmm.
between now and then. I mean, we can talk
Right.
about that quick in a second.
Yeah.
But I think the September meeting has become quite live, and the market's been thinking that for a while anyway. So that's not necessarily a big differentiation in terms of views from consensus. But when I looked this morning, the market was pricing about 17 basis points for September. I would
Okay.
say that maybe in closing on this first part, if depending on the directionality of the data and the cadence of the data, particularly on the labor market side, but obviously also inflation, if the labor market falls off quicker than the Fed expects, and the Fed is not expecting that to happen, the Fed thinks that labor's in a very good spot, and the unemployment rate currently at 4.2 is only going to get up to 4.5 this year and next. So that's still pretty respectable labor market.
Right.
If the labor market falls off more than the Fed expects, then I think there's an outside chance that the Fed might cut 50 at the September meeting, which ironically is kind of what happened last year, although for different reasons. There was the big discussion around cutting in July. They passed. I think Powell wanted it. He got overruled, and then they ended up coming back last year in 24 and doing 50 in September. Now, that's not a base case, but you need to see a few things happen there. But I'm thinking about that a little bit more here as we kind of work through particularly the last couple of weeks.
So in that case where you do see 50, you would probably, I'm assuming based on your comments, you would need to see inflation underwhelm Fed expectations, so come in a little bit softer with the tariff pass through and labor market deteriorate in order to see that. Is that fair?
Yeah, that would be one path. The other path is that inflation remains somewhat frothy, or at least kind of gets a little frothier. Call it zero point 0.3 on core PCE on the monthly, 30 basis points in the round. But
Okay.
the unemployment rate, or at least the labor market initial jobless claims, kind of overwhelm a slightly higher inflation number. But the labor market is becoming such an issue that the Fed pivots away from focusing a bit more, I think, on inflation and a little bit more on trying to make sure that the labor market stays at max employment, which is obviously the other main plank of its dual mandate.
Perfect. Let's shift over to fiscal policy in the U.S. The big, beautiful bill is working its way through the House and Senate, and seems like there's some changes that are being made. What's your expectation for the final version of this bill? How similar is it to what we're seeing now, and then also what are the broader implications?
Yeah, there's a lot of focus on this for obvious reasons. I think so the House has passed its version of the bill. Um, and the CBO, Congressional Budget Office, scored it a few weeks ago, and somewhat surprisingly, made it relatively deficit neutral, which was a surprise. Most people did not expect that. The CBO took into account estimated, to be fair, and we'll see what happens on tariffs, but estimated tariff revenue, and use that revenue as kind of a marker against the spending in the bill, which is a little bit different than how the CBO would normally do things and maybe expected to do things. So that was a bit of a surprise. And that was one of the reasons why you didn't see the back end of the bond. Remember, a few weeks ago, the back end of the bond curve was, 30-year
Right.
yields were above 5, well
Sure.
above 5. And it's like, okay, where are we going? Could this be materially higher? And that CBO scoring, a lot of that concern about back end going higher was around fiscal and spending and issuance and that sort of thing. And when CBO scored the bill somewhat friendlier than traditionally it would, then that has helped somewhat surprisingly calm the bond market jitters a fair bit. Now the bill is in front of the Senate, and the Senate is looking at slightly different numbers, as it often does, than the House. And there's some differentiation in or on the spending side. That could be a little bit more spendy, but the timing of the spending is a little less linear in terms of how it goes, and it's a little bit kind of less at the beginning and more at the end. So I think I think the Senate bill, I think the Senate will obviously pass something, and then there will need to be a reconciliation process between the House and the Senate. Now,
Right.
the White House has wanted the bill to be done by July 4th. I have been skeptical on that for a long time for a lot of the reasons that I just spoke about, and they have some time for to be sure. First of all, the tax cuts from TCJA, the Tax Cut and Jobs Act, or the Trump tax bill 1.0, do not expire until the end of this year. So it's not immediate. The bigger immediate rush here, I think, is the X date when Treasury may run out of cash, and that could be a bit of a problem. So that's the whole debt ceiling story. So, this bill encompasses the fiscal spending, it encompasses the debt ceiling stuff, it encompasses immigration reform. That's why it's called the One Big Beautiful Bill, because it's beyond a lot of traditional fiscal tax and spend, and there's a bunch of other things in it. And Trump has wanted to do it all together, hence the name, one Big Beautiful Bill. And eventually, I think this will get done, but I think we're looking at late July or early August for this to get done.
Okay.
I've seen some revenue projections recently that the June revenue projections or tax collections from the Treasury, June 15th, which we obviously just had, were not as high as expected. So some people think that the X date, when the Treasury might run out of cash, is a little bit earlier than expected. I've been kind of looking at mid August plus or minus,
Okay.
and maybe it's going to be a little bit earlier in August. So then there's a bit of an issue. Now you could pass a bill in the meantime, so it wouldn't be one big beautiful bill. You could pass a separate bill, as is often done around the debt ceiling, and just have that done. And so that X date is a non-event, and it
Right.
shouldn't be a problem. But in terms of the fiscal spend here, I think we've got sitting here mid June, I think we've got probably a good 6 to 8 weeks to go before it happens. We need to get through, I think, one or two more committees on the Senate. Then it needs a full floor vote, and then it'll need to be reconciled between the House and the Senate committees. That could take some time, and then both chambers would need to vote on it, and there could be also some hiccups there. So this is not necessarily an easy process, and there could be some consternation in markets in terms of what's happening. But I think that in terms of what could happen for markets, I mean, there are asset class implications. They're probably a little too detailed for a macro podcast here, but there's spending obviously in various things and what's happening in, say, cannabis and healthcare and biotech and defense and all those things that I think are important. But what I think has changed here in the last maybe 60 days, Matt, is the concern over a big fiscal spend, a lot of issuance or significant issuance, maybe coupons, like longer part of the curve of the US, and who's going to mop up all that supply, that additional issuance, that additional supply, who's going to mop that up? And if there isn't anybody, then that means, prices lower, yields higher, and does the back end of the curve run away? That seems to have gone away, or the risks around a big move there seems to have gone away. And that's probably the big change I want investors and listeners to this podcast to take away, that I think the sentiment around that has changed. Doesn't mean we can't have a surprise, and that's possible, but I don't think that that's kind of the base case or close to base case at this point. I think that it's very much a taily kind of risk case at this point. So, I think the bond market has shifted. I mean, it's clearly still looking at all of that, but I think the bond market and equity markets and FX markets are looking at other things and other drivers, and not looking at the bill as potentially a material event one way or another that
Hmm.
would push at least broad equity indices, the broad bond market in a massive way, one way or another.
Interesting. Maybe they'll stick on that, and I'll try to dig a little bit deeper. I guess I'm curious, particularly about bond market and the repricing of that as less of a risk. You mentioned that that was on the heels of the CBO coming out, giving it a better rating due to tariff revenue. I would love to know how they project tariff revenue because it seems like it's fairly chaotic and there's deals on and deals off, and who knows where we'll stand on overall tariff revenue. So maybe transition to that. And do you have views on where you'll end up with tariffs? And is there some sort of base level of tariffs that the Trump government feels like they need to bring in order to offset some of this fiscal spend?
Yeah, it's a great question. I mean, to be fair, we're all trying to figure out as best we can where the tariff revenue is, and CBO, yeah, and it may or may not have an edge, but probably if it has an edge, probably not massively above really anybody else. That's a good forecaster on the street. I think the CBO is using revenues based on what it's seen so far and what it thinks is a central tendency given where we're at. So we were at one point, when the China numbers were clearly huge at 145, 145%. People were thinking maybe 700 plus billion in revenues per year coming into the U.S. Now with that coming off, and obviously there's been a couple other little things going around. It's closer to around 300. Last I saw was 270 billion. And so the CBO is obviously making assumptions, but of course, CBO always makes assumptions, right? Because part of the scoring is dynamic scoring. So it says, okay, so just an example might be, okay, you're going to invest this much in infrastructure in the economy. Okay, well, CBO, think that the net economic impact on the economy is X. And so there are assumptions built into that dynamic scoring model. And we saw it here a little bit too with the Liberal platform coming into the election late April. Um, in terms of what's dynamically scored and what is not, and are your assumptions good? Like any model, are they not? Are they a little aggressive? Are they not? So the CBO could be wrong, and but it's probably one of the better guesses, educated guesses around.
Hmm.
And so I think that's how the CBO is looking at it at this point. I agree. I mean, I think we've got a long way to go on a lot of things. I mean, clearly, from what we saw from G7, at least before Trump left, and then Besson, actually, the Treasury Secretary Besson went and replaced Trump for the rest of the conference. Um, U.S. and Canada are trying to get a deal done within 30 days, which is inside 30 days now, since that announcement was a few days ago.
Right.
It doesn't seem like there's a lot of momentum on the Japan side. Just
Hmm.
speaking, or at least reading, listening to what Japanese officials are saying. There's the India deal, UK deal seems to be a little bit further along. The China deal seems to be problematic and probably very sticky on a number of things. Kind of back to what I said a minute ago in terms of the big risk on the bond market from a big fiscal, who knows what happens. I think the market, and maybe wrongly so, but I don't think that's the case. But unless something really odd happens here, it doesn't look like we're going to have pick up a very big number. It doesn't look like we're going to have U.S. Tariffing China on 100%, like by 100%. It seemed like that central tendency, that range, seems to have come down significantly. I don't know exactly where it's going to go, but somewhere between 10 and 40% seems to be not unreasonable. And those are still big numbers, and I'm not pretending that they're small. They are not. But the big 145% in that kind of neighborhood seems to be off the table for now. And I think that's given some solace to the market, particularly also obviously not only on the inflation side but also on the growth side. So that's how I think that's one of the reasons I think the bond market's also, particularly the back end of the curve, is behaving a little bit better, at least for now, because I think those big risks that were looking very prominent maybe 60 days ago seem to be a lot less likely now.
Why don't we move to currency? I'd love your view on U.S. dollar. There's obviously been lots of discussion, and perhaps this is reversed a little bit, latching on to your other comments on the back end of the Treasury curve. concerns about funding. There was concerns about U.S. dollars sort of eroding. I won't say losing its reserve status, but eroding as the base currency over time due to a lot of these fiscal imbalances
Yeah.
and geopolitics as a whole. Where do you stand on that? What's your view on the dollar?
I mean, fiscal as a market driver has been growing in importance here over the last 6 to 12 months. And as a part of that, when you look at the US and you look at the deficit numbers, they are large. And they're not the biggest around, but they are large. And the US gets a little bit of a pass because of treasury market being kind of the global benchmark within fixed income, and obviously the dollar as the global reserve currency of choice. And some of these projections that we were just chatting about now basically does not see the U.S. in a recession, but the deficit running at around 6.5% a year. But a recession, and there needs to be fiscal spend that could push it up to who knows what, 8, 9, maybe 10%. And that's another echelon, and that can be some problems, and that can wear away maybe on investor appetite for treasuries, U.S. treasuries, bond market, and the U.S. dollar. I think that the first half. I know we've done a one or two podcasts since, but I think the first half of April was very significant around Liberation Day, and in particular, I mean tariffs, of course, but what I'm referencing here is the breakdown in traditional cross asset correlation. When you saw U.S. equities lower, when you saw U.S. Bonds lower, prices lower, yields higher, and you saw the dollar, U.S. dollar, lower as well. All three things happening for a number of days and weeks in conjunction. And I think that got a lot of global investors, a lot of global institutional money managers concerned about just what is the safe haven status of the dollar. I mean, a lot of us, I've been in the business for a little while. A lot of us in our careers have generally only known one thing with respect to safe haven is that the dollar, and there are others, but the dollar generally performs well. Treasuries generally perform well in periods of risk off. Not always, but most of the time. And I think that breakdown in cross asset correlation early April has really concerned a lot of people. And so I think that while I don't think the dollar is losing its reserve status, I don't think the treasuries are necessarily losing their safe haven bid, as we would say. But if you thought that there was maybe a zero point 0.9 correlation or a zero point 0.9 beta around risk off events and those two assets, maybe that number is lower. I'm not saying it's a zero, but maybe it's gone down to 6.5,
Right.
or 0.65 or zero point 0.7 or something like that. So if that's true, then as a money manager that's managing risk, the right thing to do is to pare back some of the risk associated or that you think is going to happen from a risk off event, that whatever you have leaning towards US dollar assets. And so that can kind of metastasize in a couple of ways. One, you can just sell the asset, of course. And the second is, particularly on the FX side, getting back to the question, is you can hedge and hedge more. And we've done some work, and a lot of other great shops around the street have also done a lot of great work on this. And it's very well known that a lot of like non-U.S. global institutional equity managers not only are overweight U.S. equities, no surprise, but are what I would call relatively thinly hedged, maybe hedging those exposures at 10, 20, 30%, something like that. And that number, given what I just said a few minutes ago around the safe haven, and maybe it's not a zero point 0.9, maybe it's a zero point 0.7 or a 0.65, that will require a lot of people. If you believe that, then it would generally require a lot of people to say, okay, I need to hedge this more because I can't bank on, or I have less certainty, or I've got less confidence that if A happens, then my portfolio will react this way. So the hedging ratios probably need to go up. And so what we've seen, I think we're still in the second inning of it, is global institutional portfolio managers, particularly equity managers, because fixed income managers generally hedge a lot more of the percentage of their portfolios than do equity managers. That's why I'm focusing on equities. It's not only about that, but it's mostly about that. We've seen the beginnings of people hedging those U.S. equity exposures more, and the dollar equity exposure, and that has a negative impact on the U.S. dollar from a flow, from a flow perspective. And so that means that there's a chance that the dollar is, to borrow an equity saying, this dollar is a sell on rallies proposition.
Right.
Anytime that there's strength in the dollar for whatever reason, kind of short term over a day or two or three, an FX hedging manager or an equity portfolio manager that does their own hedging may say, okay, great, thank you. That's wonderful. Now I'm going to hedge at a slightly better price, and that's hopefully constructive for their portfolio. So that's really important. We have this trade on against euro and and Australian dollar, kind of what I call a structurally weaker U.S. dollar over a long period of time via some option strategies. And we have a couple other small things that were on kind of before April 2nd that directionally go in the same way, but they weren't put on for that reason per se. But we've added some risk over the last couple of months based on the back of that. And I think that that's a really important macro theme here going forward, and maybe the most important macro theme for 2025 into early 26. And then maybe just tying this all together, as these things often are all very related and correlated. The dollar, or at least the U.S., the Fed, is right now again 4.25 to 4.5 in terms of its Fed funds rate, and that happens to be the highest administered policy rate in the G10. Of course, there are others that are higher in the emerging market space for sure, but in the G10, that's the highest, and so it's expensive to hedge because you're paying away that higher interest rate. So if the market starts to price in Fed cuts, and if the Fed does end up cutting rates and maybe cuts rates a little faster than the market expects, kind of that risk case around 15 September that I said, I think you're going to see the US dollar, really move pretty quickly, because people will be more comfortable putting on those hedges.
Sure.
Global equity asset managers will be more comfortable putting on those hedges because they'll be cheaper. And that may be one of the reasons why it's been not slow, but maybe a little bit slow, kind of get out of the gate here in terms of seeing the dollar materially lower. It's expensive to do that trade, but the Fed narrowing the gap between where US rates are and maybe the rest of the G10 will, that interest rate differential, which a lot of us know just from pure economics, textbook rate spread differential, that probably will kick in and push the dollar lower. So that's a key view that I have and we have on as a team. And I think it's a really interesting and important macro view here for the duration of 25 to 26.
So you referenced having that on in the portfolios. What else are you doing in the portfolios, Dustin?
There's a lot. There's a lot of stuff going on. I think duration within a fixed income portfolio, duration is always the most important thing.
Sure.
We continue to have this spread trade on between U.S. rates and Canada rates in the 10-year space. For anyone that maybe hasn't heard it, or just a refresher, U.S. Canada 10-year rates got well into third standard deviation territory, probably around minus 130 or 140 basis points, and we thought it was way too much compared to where that spread normally trades. So we've been looking for that spread to narrow. So we buy U.S. duration and you sell Canadian duration at the same time, equal DV01, and then you kind of make on the spread, and that spread has moved to about minus 105 or minus 100. So it's moved in our direction a fair bit, and we think it could go maybe to minus 80 or even minus 70. So that's been great, and that's been probably our main duration play for a bit. A few weeks ago, as post Canadian election and all the discussion around NATO spending, 2% and maybe even 5%, and going into G7, which has happened as we record this podcast, but we're ahead of the NATO summit, which is happening next week, the last week of June. There's been a big push, and kind of 5% is now the new 2% in terms of spending for defense, country defense.
Right.
Canada is running relatively low within the NATO set, I think running around 1.4, and it's been slow. Right, that was one of Trump's big gripes with Trudeau, is that Canada's not spending enough, and was harping on Trudeau a lot for that. And Carney has subsequently come out and said that we're going to get to 2% pretty fast, but that ship seems to have already sailed, pardon the pun, and it seems like 5% is the new 2%, which is interesting. So the fiscal story in Canada is challenging because we don't have a budget, as I'm sure many people know. And so, what is the spending? Where is it on defense? What's it going to look like? We think that there could be additional issuance that comes in the longer end, or maybe the belly to the longer end. So maybe the 5, 10, 20, 30-year part of the Canadian curve to pay for not only the 0.6%, 1.4 to 2% on defense spending for Canada, but we may need to do a little bit more depending on how things go next week here. So we are, in addition to that spread trade I talked about a minute ago, we are additionally short more Canadian longer end duration to message, particularly the what we think is going to happen on the issuance side, more issuance, more paper being issued by the Ministry of Finance in Canada. Who's going to mop that up? Are there going to be enough buyers? That sort of thing. For a long time, there were enough buyers, and Canada, with a big pension system and a lot of very smart, savvy ALM, asset liability matching pension managers, there's often a strong bid for the long end of the Canadian curve, but we think that a lot of that is now done, and
Okay.
there's risk. So that's the second thing I would say that is pretty significant. We also think that the curve can steepen here a fair bit. Kind of goes back to my particularly the U.S. curve, and that goes back to my comments around Fed and could they cut a little bit more and those things. So it's a little bit more the front end of the curve than the back end of the curve moving. This is more a little bit of a what I would call a hedge trade as opposed to an alpha trade.
Hmm.
But we've put on what we would call some curve caps on the U.S. curve, looking for the curve to steepen out between the 5-year space and the 30-year space over the next 6 months or so. And then we continue to very cautiously add into EM portfolios, particularly Brazil and Mexico. Brazil just hiked yesterday to 15 basis points, and we think, and a lot of other people think the same. To be fair, that Brazil has finished its hiking cycle, and generally, but not always, generally, when central banks finish their hiking cycles, it's usually a very good time to start um, buying duration or buying fixed income. And we've been in that trade for a little bit, expecting that we're close to the end of the hiking cycle, and the carry, the yield coupon on those bonds is obviously quite good, given that you're at 14-15% on nominal rates.
Right.
But now that seems to have been done, I think we're probably going to be adding a little bit more here, and I think that's a good trade. Of course, with every EM and in every economy, with every EM, you have to be careful with the idiosyncratic risks. But there are elections in Brazil next year. We think they will be relatively constructive for markets, and we like capturing that yield for investors, particularly in our global funds and in our unconstrained funds. So, in terms of the macro trades, in addition to the currency trade I mentioned a few minutes ago, those are some of the big ones that we're focused on here right now.
Well, thanks, Dustin. Thanks for walking through what's going on in the portfolios and your views on all things macro. So appreciate you taking the time.
Thanks very much for having me. Great to do this.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.